Something over water.
Listen, you have never tasted it. You've never tasted this water. Listen, I've been able to find this water one day before.
Okay, so did you guys email me your grades or give me your grades or whatever? Those of you who weren't here last time, I somehow launched quiz 6 grades. I don't know what happened. It's on chapter 7, the 6th quiz of chapter 7. So I've got most of them, but a couple I still don't have. So if you didn't give it to me, please do so. Write it down on a piece of paper or something and hand it to me, or you can tell me after class what it is. Oh, also there's an internship that's with Fire somebody. My daughter has a friend who used to be at EY and is now with a company, and he wanted to hire one of you people. I don't know why, and I don't know if he has put this one. Here we go. He is at Fire King. What's Fire King, you guys? Thanks.
I gave you the wrong grade.
Oh, okay. He's at Fire King.
I think I did. I don't know. What did I give you?
You gave it.
Okay, just kidding. I gave you probably made it up.
You can keep that, or you can...
No, you can have it. I don't even have to see it. I tell you guys.
Fire King is
Yeah, Fire King. And it's going to pay, and it's all summer. Might be a good one. If you guys know anybody that's just looking for one for summer, does anybody fit that category? It's full-time for the summer. So I asked my daughter to get me a description of it, an announcement, see if it's the placement center, and I'll email it to you guys. Okay? So I'll just keep it to class, and you can take a look at it. It'd be good to get in somebody who knows what they're doing. The fellow's name is, that's all of you guys. It's Mike Lynch. Anybody met Mike yet? Mike Lynch. He's a good guy. He was there until recently. Anyway. And he knows that if you go directly to a professor and ask, you might get somebody faster. Get somebody All right. Let's do some stuff from chapter 9, the last one. When are we doing a quiz on this stuff? Wednesday. And then when do we have a test?
This weekend.
Over the weekend? Yeah, following weekend. And then when do we have a final? Yeah, that's it. Okay, we're done. Okay. Did I get a score from you? Email. Email me. I don't know how I managed that. I think I wrote it down on a piece of paper. And I'll find it as soon as I get them all. Okay, we did purchase commitments, didn't we? Let's do gross profit method of estimating inventory. That's where we were at. Let's take a look at these. The first half of this chapter is really easy. The second half, kind of a pain, probably, when you get into the retail methods. So we'll fumble through some more of these. Gross profit method of estimating inventory. I think the way they do it is really strange.
Yeah, I thought it was like really strange.
Backwards.
Yeah, it was.
But it's okay. There's nothing wrong with it. What they do is they subtract the gross profit, and then to get the inventory, why don't you just take the gross profit percentage times the sales to get it? I don't know, but you can do it either way. Suit yourself. We do need, though, to get the idea of what markup is versus margin. Did we do this before with you guys? No. Let's do a little problem. Let's say my sales price is $100. My cost is $75. That would give me a what? Gross profit of 25. Does everybody agree with that? Okay. What's the markup here and what's the margin? Be really careful with these terms. Marketing people a lot of times like markup, and you're going to understand it where that makes a lot of sense. We usually talk about margin, okay, finance and accounting types, okay? So what's the deal? What is the margin here? We talk about that all the time. Gross profit percentage is the margin, right? The gross profit margin is what? 25% here? Everybody agree? Gross profit percentage is 25%. 25%. I mean, it's just easy, 25 divided by 100 now. What's the markup percentage? Two ways of doing it is a problem. The markup here is what? How much was added to cost? The markup is 33 1/3%. That's one way they'll say it. Guys, if they say the markup's 33 1/3, that means the gross profit is 25%. They're related to each other, aren't they? Mathematically, they're related. That's it. Another way you could say it, though, is take the sales price and divide that by the cost. It's 133%. 133 1/3%, right? Both of those are called markup. Oh man! So when somebody says that the markup is more than 100%, which one are they talking about? Well, not margin. They're talking about this type of markup. Probably. Okay, but you know what? You could have one like this. Let's do sales price is 100. Cost is 20. Gross profit is 80. Anybody have stuff like this? Absolutely. Lots of people do. High-tech products are this way a lot. Drugs are this way. What's the deal? You have a whole bunch of fixed costs that you have to cover, right? So your contribution margin has to be huge. Right? That's okay. All right? It's fine. Fine furniture would be like this. Jewelry would be like this. Right? And it doesn't mean they're making excessive profits necessarily. It just means what? They have a lot of fixed costs, right? Okay? So what would the margin be? Gross profit margin. 80%. 80%, right? That's the gross margin or gross profit. Gross margin percentage, gross profit is the same thing. Okay? Everybody agree? That would be 80%. What would the markup be? 400%. 400% going this way. Markups just sound impressive. When you look in the financial press, somebody's charging a 400% markup. I've actually talked to people who don't understand business. They'll say, well, yeah, they make 4 times the sales price of profit. Can't make more than 100% of the sales price of profit. If your cost was nothing, right, your gross profit percentage would be 100%. You can't do better than that, right? If you sold them nothing, you still can't do better than 100%. So it can't be 400. But it sounds cool, doesn't it? In a headline. So be careful with these things. What do you mean? Okay. A gross margin of 80% is pretty high, right? Okay. But it could happen, obviously. What if we do it the other way, guys? What's this markup? Now it's 500%. What you have to do is ask them, what do they mean? Right? What do you mean? When you tell me that your markup is 400%, what do you mean? Or you tell me it's 500%, what do you mean? What's the relationship? Is it sales divided by cost, or is it the gross profit divided by cost? Different things, isn't it? Okay, that's all. So can you convert one of these into the other? There's a couple of exercises I had you do, right? Make sure you do them. Make sure you can do that. And they show that on page 486. Markup relative to retail, markup relative to cost. Yeah, okay. That's lovely. Okay, and gross profit percentages. Okay, what if I wanted to get an estimate? Well, first, why would I want to get an estimate of my inventory? Why would I want to use the gross profit method for estimating inventory? When would I do that? Why would I do that? Would you count your inventory?
Wasn't it easier to reduce having to count it frequently for interim periods?
Okay, I want to do quarterly statements. I want to do monthly statements. And you can count your inventory 12 times a year, and I can count once a year. Physical count. So if I'm using which inventory system, and I want to do quarterly financial statements and monthly or monthly financial statements, which type of inventory method would I be more likely to want to use this method of estimating inventory? When would I need to estimate my inventory? When would I already have an estimate of my inventory? Would it really estimate? When do you continuously know how much inventory you are supposed to have? perpetual. When do you not know at all how much you're supposed to have? Periodic. Guess what? If you're periodic, you would have to use a method like this to estimate your inventory and do interim statements. If you got perpetual, you already got an estimate, right? So why would you bother? You good? I mean, you could still do it. You could still estimate using this method if you were perpetual and make sure your perpetual record was approximately right now. But probably the perpetual record is going to be more accurate than a method like this. Okay? So you got the idea? So what we do is we say, well, what were my sales? And then what should my cost of goods sold be as a result of the sales? Are you guys aware of this? This is just a remarkable concept. For inventory, the beginning inventory plus the purchases is what's available. Subtract the cost of goods sold is the ending. From last time's financial statement, I know this one. If I'm doing periodic, I know this one. I can add the two together. If I get an estimate of this, guess what? I can compute this. That's all they're doing. Okay, so what do? We come up with an estimate of what cost of goods sold is compared to what? It's a percent of I hear sales up there. That's nice. What percent is this of sales? That's sales. As soon as you've got it, what can you do? Take the sales. Do you know the sales? Well, yeah. You got a sales account. Everybody's got a sales account, whether they're periodic or perpetual, doesn't matter. So if you knew that this is 300,000, say, okay, and you know this is 50,000, right? And you know purchases is 200,000, okay? And you know that historically you have had a gross profit, let's say a gross profit percentage. This one is 100% of itself, right? Let's say that historically this has been 25%, which means cost of goods sold is how much? 75%. It's that simple. Okay, what would we do? I know my sales, let's say it was 300. If I know my sales are 300, can anybody give me an estimate of what cost of goods sold must have been? The way the authors do it is they take 25% of the 300 to get 75, and then they subtract the 75 from the 300 to get 225, and that's, like you were saying, that's kind of silly. Why don't you just take 75% times the 300 and get the 225? What would that be? Debit cost of goods sold and credit what? Inventory, of course. 225 would come out of here, so what's my ending inventory? Glad I didn't make it negative. What do we got? 25. How could you not be able to do this? That's all they're doing, okay? So you can set it up, formula the way the author likes to, or you can just use common sense, I don't care, right? So when we look at that, that's what they're doing. Approximate the inventory. And what we do is each month or each quarter, however often you're doing financial statements, probably monthly, right? You'd make this adjustment. You'd create an income statement, right? For cost of goods sold, we would take our beginning inventory that it was at the end of the prior month. We'd add the purchases for that month. We'd get the available, right? So we'd have each month and then year to date too, columns for both. And then you'd subtract your estimate of the ending inventory, and guess what? You would get your estimate of cost of goods sold, and that's what would hit your income statement. Okay? Easy. Anyway, that's what's cool. Get excited. Let's see. What else do we got? Retail inventory method concepts. This stuff makes perfect sense to me. Try to take a look at it. You've read this chapter by now. Crank through it. You thought it was easy? You want to explain it to us? Who would use this? Oh, please, no, thank you. Who would use retail method? Retail method. Retailers. Yay! All right, I think so. And here's the deal. Retailers typically know what the retail sales. Who are retailers, by the way? Retailers. They sell at retail. Has anybody ever been to? You guys only do retail, huh? You don't sell your product, oh, yeah, no, I take it back, you do too. You sell your product to the Dick's Sporting Goods and stuff too, don't you?
Yeah.
Yeah.
So with that, you're a wholesaler. But when you're in your own store, you're a retailer. Yeah, so, okay, right? So if you go to the Apple store, Apple's got their stuff, right? And they're a retailer. If you go to Best Buy and buy Apple stuff, what's the deal? Now they're a wholesaler, and the retailer is Best Buy. It's just whoever sells the general public. You got to remember the pattern. Okay, so retail. So the nice thing about retail business is you know what your sales prices are. How do you know? You go to Kroger, how do you know how much milk is? You know, where the milk's in the case there, you know, in the freezer, or it's a refrigerator, not a freezer, I hope. Okay, where the milk is, it's in a refrigerator, and right, you know, in front of the thing, there's a little price tag, right? It tells you how much it costs. Used to be they actually put it on the goods. I like that so much better. You know what I like it for? I mean, you can tell what it costs when you pick it up at the store still.
And they get like shifted around.
But when you buy a new one, you know what the old one costs when you throw it away. So you got a bottle of ketchup, which has absolutely no food value, right? We don't have ketchup in our house either. But anyway, it doesn't have food value. Did you know that George Bush Sr., I think it was? It's hilarious. I'm pretty sure it was the senior, not the junior. They were deciding what vegetables kids were having at school. You know about this one? And he put on the list of the vegetables that they had at school, no kidding, the administration did, tomato ketchup. And then somebody pointed out to them that it was 90% sugar, and there was almost no tomato in tomato ketchup, so they took it off the list. Well, yeah, they're having vegetables, we didn't tomato ketchup. Yeah, anyway, so fun stuff. Discovered. But anyway, you used to be able to look at the price tag and you threw it away. And then when you went to the store and it cost 80% more, you know, the next time you bought it a couple months later, you know about it. They got rid of that. Standard did it for them, right? So you can't even tell what it cost you once you get it home. You have to record it. What's that? Yeah. Well, there's an app where you can do that now, where it'll track how much you paid last time automatically and compare it to how much you paid this time. Isn't that cool? It's a neat app to develop. You can get one if you want, but you still have to look at it. Track all your purchase prices. Then you know how much you're being charged, I guess, compared to what it was. Okay, what can you do with the retail method, though? You can capture inventory, and guess what? You don't have to go look up the cost. You can write down the retail prices. That's it. That's who would use this. So it's pretty, you know, when you look at it, say, what the hell? What are they doing? Okay, so that you don't have to go look up the cost. Was this convenient? Yes. So what could you do? If you know the relationship between your retail sales price and your cost, you can estimate the inventory. Just like that. That's all this is for. Now, here's the deal. You're going to love this one. Do this to you all the time, don't I? So will Alan Beck and Richard Sugar. You're going to do it too. Most schools don't bother to cover this stuff. Why? I think it's hard. The book's kind of long. Most schools do this book in 2 classes, and they cover about 2/3 of the chapters. We spread it across 3 classes, right? And we pound through it all. So, you know, when you get questions on the CPA exam relating to this, you'll probably get 1 or 2 little questions. You'll know how to do it in your competition. Well, it's another one of those. So it's kind of a pain to do this. But, you know, there are companies still out there that do this stuff. And in your career, when you run across something and, you know, you're with a new group of people working for a firm, right? Working in a company. And they hired a bunch of people. And somebody says, does anybody know how to do this ridiculous retail inventory thing? We just bought a company and they use the retail inventory method. What are they doing? You're going to, oh yeah, I sort of understand that. I can figure it out. And everybody else says, yeah, I never heard of that. I'm not kidding. And personal experience has happened numerous times when I started our grant in public department. Did I tell you guys this on the cash flow statement? We went in and it wasn't called a cash flow statement, it was a statement of financial position. Statement of changes in financial position. Yeah, that's a balance. Statement of changes in financial position. So that's what it really still is. Except they changed it to be just cash and used to be current assets compared to current liabilities. It was the same thing. Anyway, they just come out with a statement. And and they had an APB, Accounting Principles Board opinion, right, on the thing. Now it'd be a FASB. Came out with the thing, and so the senior comes in and he flops down a set of working papers. They were manual at that time, and we were sitting in a room like this, kind of, all the newbies, hanging out, and we were studying for the CPA exam, and which I had already passed. I was kind of nice. I guess I was doing that, but anyway, they flopped the work papers down, and he did. He says, "Does anybody know how to do one of these statement changes in page position?" We all look at each other. Well, what do you mean? And me and one other guy who went to Brigham Young, and I found the University of Puget Sound. And anyway, we both said, "Well, yeah." And then the other one started explaining to him what the ATP said. He says, "No, I read the ATP. I know what it said." And they read it for a theory class, right? But they didn't know how to do it. And this other guy and I knew how to do it, so we did it. Well, do this, do this, and do this with these numbers. If you guys do a cash flow statement in your sleep, right? By the time you're done here, big deal, right? You're gonna have competition. Who can't? I'm not kidding. It's ridiculous, right? It's easy. So you just do it. Guess what happened? The guy staffed his next job. Everybody else was still sitting in the office. Me and that other kid were out on that job with him. Kid, these little tiny things, guys. It's all this crap that we make you learn. Remember what we're doing. You're going to pass the CPA exam, and you're going to have some clue of how to do something when you go to work. That's why you're doing this, right? And this isn't a philosophy class, right? Not a theology class. I don't think, right? Can you do something, right? And it's not memorizing how to do crap. It's knowing what you're doing, right? And you guys are sort of getting there. So as you finish up this chapter, why am I pounding you through all this stuff? Because there's nothing else to do anyway. You might as well, right? That's pretty much it. So into that. So what do we do on the retail method? Oh, notice who uses this. Target, Home Depot, Sears, Bloomingdale's, little outfits, little fancy ones. Hey, did you see that Target raised their starting salary? All the way to $10, was it? You know why that happened, don't you? A couple other companies did too. TJ Maxx did. Yeah, $10 starting salary.
Starting wages.
Yeah, beginning wage. $10, not minimum wage. $10. Why did they do it? To compete because they can't hire people anymore. Who did it first? Walmart. Walmart always said we can't raise wages because of competitive pressure. And then they finally got enough pressure on them from other sources, right? Raise your wages, raise your wages. We're paying people welfare that are working for you. We're giving them food stamps. Tax dollars are going to your employees and making the owners rich. All that stuff, right? I told you guys this stuff. Anyways, they raised it by $1. Guess what? Everybody else has had to do. It's spreading to our entire economy. What's happening? Everybody's raising it by $1. So what do we need next? Seeing as you can't live on $10 an hour either. You guys live on $10 an hour? You might make $10 an hour, but you're not living on just that. You're being subsidized by your parents, aren't you? Right? Yeah, absolutely. What happens if you graduate and make $10 an hour? You can't eat. Come on, you can't eat, right? You can't pay rent. So what should the wage really be? Probably 15. So what does Walmart need to do? Seeing as they're the largest employer in the world. Bring it up, bring it up. Are they going to do it voluntarily? Interesting. Maybe if nobody shops there. Why'd they raise it by $1? Their sales were just disappearing. People were leaving them for the companies that treated their employees better. If you don't like the way some company does business, which should you do? Don't do business with them. If we would do that, capitalism would really work. No, I don't want the president of your company to make $100 million a year, and you pay your employees $7 for it. I don't like that. I'm not going to shop with you anymore. I'm not going to buy things from you. I'm not going to sell things from you. I'm not going to do business with you. I'll do business with somebody who treats their people better. I don't think you should do business with companies that intentionally pollute the earth either. What do you think? Just don't do it. Like that Under Armour probably is doing. They're using slave labor in Asia to produce those products. Yeah, yeah. How many of you are wearing something made in the U.S.? Anybody? And look at what we're wearing. I don't think I am. You have something made in the U.S. on? What's that, your wristband thing? A piece of jewelry made in the U.S.
It was made in China, and it's like a symbol for U.S. or something.
Yeah,
They
sad,
always
it's
do,
sad, yeah. So,
Made in the U.S., they put it together.
you know, if you insist on wearing only clothes made in the U.S., most people wouldn't be wearing much probably, yeah. It's sad, so, anyway, yeah. I don't think there's anything wrong with international trade. I don't think it apply that. It's a good. Okay, anyway. Tell me what a markup is, and a markup cancellation, and a markdown, and a markdown cancellation. This is too obvious.
Markup the price of retail, and the cancellations, if you get rid of the markup, then you cancel it. Yeah,
So you have a normal retail sales price, right? Markups would be, you're charging more than that. That's it. Markup cancellation, you changed your mind and lowered it back down. So you'll just take the net of them, and it's the net markup. Got it? Okay, that's it. Markdown. The reverse, you sell it for less, right? And markdown cancellation.
Oh, you're not marking.
Changed your mind, right? And mark it back up. Yeah, okay, right? And take the difference. So you can always take the difference. Sometimes they'll give you both of them, markup and markup cancellation, markdown cancellation. Sometimes they'll just tell you the net. They gave you the net, wonderful, you don't have to do it yourself. But it's just not a big deal. So to get these terms, okay? What's the cost per retail percentage? Take a look on page 489 to show the first.
How much your original cost is compared to the retail cost, let's say, to store it.
Yeah, the retail sales price, yeah. So take a look on page 489. They show the beginning inventory plus the purchases at cost and retail, right? And then they deduct the sales revenue. So they have them both, right, at cost and at retail. And then, so you've got your inventory at retail. Yeah, remember what you did. You counted your inventory and you wrote down the retail sales price. Then you multiplied the retail sales price times the inventory. Do it at your computer probably, right? And then you add up all the retail sales prices. I know my inventory at retail sales price. I'm going to estimate what it is at cost. Do I also know the beginning inventory at cost? Yeah, whatever I estimated maybe. Or the beginning of the year, I actually counted it and costed it out, right, guys? Once a year, I'm still doing that, okay? And then what? I'd add my purchases. I know what they are at cost. I know what they are at retail. I know what I intend to sell them for. That's normal retail. And they've got then available at both cost and retail. And what would you do? Compute a cost to retail percentage by dividing the cost by the retail. That's it. Be sure to include the beginning inventory. Include the beginning inventory if you're doing which method?
Conventional.
Conventional, which is an approximation for lower cost of market. Okay? Right? And right? Average. Okay. Did I say that right? No, conventional is the one where you don't include it.
Conventional is
The markups.
just
Markdowns. Yeah.
Markups only.
Yeah. Markups only. Don't include markdowns. And we'll get to that in a second. And why you might do that. It looks funny, but it makes sense. It's a rough estimate. Okay. Anyway. Then they deduct the sales revenue. We don't know what the goods cost. That's the whole point. We're going to estimate that. So we deduct the sales revenue, and look, you got the inventory at retail. Now what would you do? Take that ending inventory at retail times your estimate of the cost percentage. It's kind of like that gross profit method, right? Very similar. Okay? So if you had 25,000 in their little example on page 489, is your ending inventory at retail, and you think the cost to retail percentage is 70, you can just take 70% of it. You got your estimate, right, of ending inventory. What would be your cost of goods sold here? They didn't show you that, but what would cost of goods sold be? It's easy. Beginning inventory at cost was 14. Purchases at cost are 63. Total available at cost is 77. If your ending inventory is 17.5, how would you get your cost of goods sold? Cost of goods sold. The beginning we thought was 14,000. The purchases are 63,000. That made the available 73. If we estimate the ending as 17.5, how much is gone, gang? The cost of goods sold. How much is it? 77 less 17.5. 595. Is that what that is? So what you guys got? Too easy to believe? That's all we're doing. Okay? Estimating. All right. So with markups and markdowns, okay, cost ratio uses markups but not markdowns is the conventional retail method on page 490, which approximates lower of cost or market. It's trying to get lower of cost or market. Okay? And then if you include them, they call it the cost method, huh? Right? If you put both of them in. So the first one is the chapter's kind of messed up the way they did this, I think. On page 491, which one are they showing? Is that conventional or is that the cost method? Which is average, really. That one is the cost method, right? Okay. The conventional or lower of cost or market method is over on page 492. Okay. And then what else is there? What are you going to have to try to keep straight here? To the extent that this is a tough concept, what kind of hangs you up here? There's an average or cost method, and there is lower of cost or market, or conventional method, and there's one more. What's the other one? Back in an appendix, isn't it?
The LIFO dollar value retail method.
Okay, we have LIFO dollar value, right? We got that, but even before that, what do we have? So there's 4 of them. What's one before that? There's LIFO. Okay, so we have a LIFO method. Now all these are retail. Okay, all are going to be retail. Retail at average cost, retail lower cost of market conventional, and LIFO. And what's the big difference between LIFO and FIFO methods? The first two are sort of average, I guess, right? First one, average or cost, and then the next one, lower cost or market or conventional. But they're really both averages for averaging and beginning inventory. What's the difference with LIFO? You keep the beginning inventory, right? And you sell the new purchase. We all know that. So all they're doing is using that there. Okay, so how would you set these up? What would they look like if you did these? To come up with it, and the big difference is how do you come up with your cost to retail percentage? So take a look on page 491. What do they do there in coming up with their cost to retail percentage? Where did they get in part A 53.9 and in part B 54.7? What do you think? On the top of the illustration 919, they show the beginning inventory cost to retail, they show the purchases, they show markups, markup cancellations, markdown cancellations, and then they gave you the sales. Real typical problem. What did they do to get the first one there, A? They included what? The markups and the markup cancellations. Where are the markdowns? Down below after they got the cost to retail percentage. Everybody see it? Huh. And then when they did part B, what did they do?
They included the net markdown.
They included the markup, the markup cancellations. They included the markdowns and the markdown cancellations. Huh. And it gave them a different percentage. And what did that accomplish? Which one's which then? Which one is going to be the average cost, and which one is the lower of cost or market?
Average is when they do markups and markdowns. Low cost of market is just markups.
Yeah. Both markups and markdowns cancellations just get netted with it anyway, okay? And the lower of cost or market only includes the
Markups.
only markups. And what's that gonna do? If you increase for the markups, but you don't take out the markdowns, what happens to your percentage? The retail sales price goes up and the cost stays the same, right? Cost is the same either case. We're just changing, the markups and markdowns are only in the retail, right? Notice they're only in the retail column. They're not in the cost column. So what does that do?
Makes the percentage lower.
Makes the percentage lower. Okay, so which one gets a lower percentage?
Markups only.
Yeah, it's gonna get a smaller percentage. Relatively, this one's gonna get a higher percentage, right? Obviously, assuming there are markups and markdowns, right? Okay, or just assuming there are markdowns. Okay, there'll be a difference, right? What does the percentage do? We're gonna take the percentage to get what? That's sort of the trick.
Inventory at cost.
We're gonna get the inventory at cost. So we're gonna know the inventory at retail, right? How do you get the inventory at retail?
Do like the beginning of retail plus retail purchases available for sale, plus like your sales revenue.
So you calculate everything that you have available at retail. Beginning at retail, plus purchases at retail, right?
Subtract sales.
Subtract sales at retail. What do you got? Ending inventory at
Retail.
retail. And then you take it times your cost percentage to get what?
Inventory at cost.
Ending inventory at cost. So if I use a higher percentage,
It's gonna be higher.
I'm going to get a higher inventory. This is going to give me a bigger inventory. This is going to give me what? A lower inventory. What would lower of cost or market do compared to average?
Lower inventory.
It'd give you a lower inventory. Big deal. All right? And if the average gives you more inventory, what does it give you less of? Seeing as your beginning plus what you buy is what you have, what's available, less your ending is your what? Cost of goods sold. If you make the inventory higher, you make cost of goods sold lower here, right? If you make the inventory lower, you make cost of goods sold relatively higher. That's all it is. Big deal. It's a very rough approximation of lower cost of market. Got it? Very rough. Okay. What will we change to make it be LIFO? Take a look at page 491. What would you do different if you wanted to make it LIFO?
You don't add in the beginning inventory.
Don't add in the beginning inventory. All you'd have to do is draw a line across where beginning inventory is under beginning inventory, and you would keep a cost of retail for the beginning inventory. And if you don't deplete the inventory, you still have that layer. It's a layer of inventory. Okay? Got it? And then what? Calculate cost of retail for all of your purchases for the year. Does that make sense? And then what are you assuming you sold?
Most recent.
The most recent purchases, and you keep the old later. Got it? It's really simple. Okay? If you can just keep them straight. So all we do here is we separate the beginning inventory and treat the additions, right, as a whole new inventory, a separate inventory. Okay? What page is that on? Back to back in appendices. LIFO retail method starting on page 497. Okay, so you separate, look at the top of page 498. Separate the beginning inventory. You see that? Do a line under it. It's the same purchases, the same markups, the same markdowns. By the way, is this approximating lower cost or market or average? The way they've done it on page 498. They put in both markups and markdowns. It's average, okay? So it's lower of cost or market, I'm sorry, it's LIFO, but not lower of cost or market. Could you blend the two if you wanted to? The author doesn't show it, but you could. What would you do? If you wanted LIFO and lower cost or market, what would you do? when you're doing your new add-ons, right? You're doing the ones that you added on for the new year. Still separate the beginning inventory. What would you do? Include only the markups, not the markdowns, when you get your percentage, right? Okay. One thing to keep in mind too, back over, should mention that, when you're trying to get your head around all of these, and then keep them straight. When you look at the method where we are doing lower of cost or market, what do you need to be sure to do? If I did lower of cost or market, back on page 491, if I'm going to do lower of cost or market, when I'm figuring out what my ending inventory is at retail, what do I need to make sure I do? I did not include the markdowns when I did my cost of retail percentage. Real common mistake is to fail to do what? Subtract the markdowns when I figure out what my ending inventory is at retail. You still have to take the markdowns out. You just get your percentage before you take the markdowns out. Everybody follow that? You got to remember to still take them out. Okay. A couple of other things. What do you do with, on page 493, special items relating to the retail method? Just little wrinkles they throw in. What do you do with freight costs? It's everything they've listed there in bold. Just take a look at it. What do you do with the freight costs?
Sorry, inventory.
The inventory anyway. It's freight in. Freight in is what? It's part of your purchase price. It's just added. But it's only added to cost. It's not added to retail, right, guys? You don't sell the freight costs, yeah, right? So usually your markup is based on what?
Included in the cost.
It's just based on the original cost of the good, right? It's not the freight cost good. Okay? But be sure and include it. You guys already know that freight goes in, right? It's part of the purchase price. Purchase returns. What does it say? Considered a reduction of cost and retail? Why would that be?
Because if you get rid of it, you're not selling it anymore. So you have to take it from the cost and the retail.
That makes sense? You got to take it out of cost and retail. Why? Well, if it was in your purchases, you would have had it into your retail expected sales price, right? If you take it out of your purchases, what should you do? Take it out of your retail sales price. Yeah, take it out both. Sure. Cost and retail. Purchase discounts and allowances. Discounts and allowances, you probably did not, right? Get the relationship between cost and retail, including purchase returns and allowances, right? Okay? So what are they going to be? Or discounts and allowances, not returns. Discounts and allowances. What would that do? Only affect the purchase cost. So these little wrinkles are kind of strange. Okay? Transfers in from another department are reported the same way as purchases from an outside company. Oh, first, sales returns and allowances and sales discounts. What do those affect? Sales returns and allowances should adjust what? Obviously your retail sales price. What about your purchases? Does it change your purchases?
Reduction of the cost of the purchase.
Yeah, it hit the cost too, wouldn't it? Because you're getting the goods back. Debit inventory credit, right? Cost of goods sold. Right? Sure. Okay. And then what about sales discounts? They say with the recorded gross, companies do not recognize sales discounts anyway. But if you did, what would you do with sales discounts? Sales discounts should only affect retail, right? It doesn't have anything to do with the cost. Like, sure, just think about it. Transfers in from another department are reported the same way as purchases from an outside company. Because you're still going to have a cost, you're still going to have a retail sales price. What's normal shortages? That's kind of a strange one. I've seen that problem, given it problems. What's a normal shortage?
Like one that they typically estimate that's reasonable.
We lose so much of our product, right? We just do shrinkage on the product, perhaps. If you're selling agricultural products, this is normal. If you're selling anything by weight, this is normal. It goes away, right? And it just dries up, evaporates.
Not like spoilage.
Well, yeah, could be spoilage too, right? For agricultural products, it can be food products. You could have spoilage, normal spoilage. You just get it. It's going to happen. When you put that are perishable, what happens by the time it gets delivered? Some of them perish. Yeah, and you can estimate how much. That's normal, right? Okay, what would the abnormal be?
It's an excessive amount.
Yeah, something went wrong. Right? You put it in a refrigerated unit, and the refrigerated unit quits operating while the truck's going cross country. And you lose 2/3 of the shipment. Or you lose all the shipment. So that's not normal. Okay? So that's all we're talking about, abnormal shortages. So what do we do though? The normal ones are included in our cost of retail percentage anyway, aren't they? We expect that. What about the abnormal? They're not there, so what do? They're deducted from both cost and retail columns reported as special inventory amount as a loss. Otherwise, it'll screw up your inventory. Okay? So it makes sense? You have to do something with that. Employee discounts, how about that one? Does the discount change the cost? No. Does it change the retail sales price? Yes. So you pick it up. That's all. Okay, guys? So some oddball stuff. And what we'll do next time is we'll work through a couple of these problems. Try and take a look at exercises for this stuff. Exercise 919 would be good. 922 is conventional and LIFO, both. And then there's some dollar value LIFO ones, 926, 927 would be good. Okay? So we'll take a look at those.